clamor for the poor man's excuse for gold. Has the shiny metal come too far too fast, though? Let's call to the charts with a man who includes silver spoons among his favorite television shows. Carter Braxton Worth. Carter, what do you see in the charts?
Sure. Well, the first thing you just said there, talking about the volume exploding. What's amazing is that the volume this week, this thing turned over twice. So it only has 370 million shares outstanding and 750 million shares in the past 5 sessions. That's never happened in the GLD. It's never happened in silver. And it very rarely happens in almost any security. Here's a long-term chart. This is the Hunt brothers. They had successfully cornered the market, got to essentially 50. The government changed the margin requirement, effectively bankrupting the brothers and dropping silver aggressively. We've returned right to that level. In principle, when you first approach a well-defined past top, you don't actually break out. You respond to it, either by backing and filling or backing away. So, again, a steep move to a very well-defined moment, a better sale than a buy right here. And the volume is an interesting tell. Here's the day-to-day. This is a 2-year chart of the SLV. And again, it's how far you can get above your average price over the past 150 days, the smoothing mechanism. In this case, this is about as far as you're going to find in any kind of market. You can look at the dot-com era, how far extended tech stocks have gotten in the past, and we're reaching what I would say is a momentum peak. It's crescendo. It's all that kind of thing, and it's a better sale than a buy.
It's a momentum peak. Better sale than a buy. All right. What's interesting, too, is silver versus the performance of, say, silver miners, silver versus the performance, let's say, of gold. It's really been outperforming.
Yeah, I think, well, as far as its relationship to gold, a lot of people are attributing that to it actually playing catch-up to gold's earlier rally. But at this point, I think we've kind of exceeded that. You know, there's a couple things that I always look to. Some are anecdotal. When I start getting calls from people who are not in the markets and saying, gee, should I go run out and buy silver? And I was getting calls like that this week. That's certainly a warning sign. But as an options trader, one of the other things that we look for is volatility. How much is the underlying starting to move around relative to the way it normally does? What are the options starting to price in? And both are starting to rise. The realized volatility certainly was higher this week. There was a pullback in the middle of the week, and that caused that. But the options prices have really started to spike as well. And when I've been trading commodities in the past, that was usually a warning sign. I've seen it in natural gas. I've seen it in crude. You know, and I think we're starting to see this in silver. And obviously, when you take a look at the futures curve as well, it was in backwardation. That's a supply-demand issue that's indicating that there's a lot of speculative interest. And that's exactly what this is, speculative interest. And I think that is also a beware sign.
Long-term call volume in SLV is about 200,000 a day, and this week it was nearly 3 times, actually more than 3 times that. So that's probably another case where it's getting frothy, and that's probably an indication that maybe it's getting a little toppy. That said, I'm not always a big fan of getting in front of a chart like that because I think I tend to get run over.
Dan, what do you think? You talk to somebody like a Peter Schiff, and they say, you know, anything that comes out of the ground and is shiny was going to go on forever.
I saw him the other day on the show, and he's amazing. I mean, he made me want to go out and buy silver. Okay, that said, I think that, it's gone parabolic in, a very short period of time. To have a move from 30 to 50 in any underlying, sort of thing, it draws me in. I'm a contrarian. I actually shorted it earlier in the week, but not through the stock. I think you'd have to be crazy to do that, and, I think Mike's going to talk about a way to do that, and we'll talk a bit more about it.
All right, so everybody, Carter, Scott, Dan, are bearish. So is Mike. So what's your trade?
Well, if we're all bearish, then maybe we should be buying it.
That's right.
Here's one of these things. Just to this point, I mean, both these guys indicated there is no way I would short this. Not with my worst enemy's money. You could get your head taken off. There's no question about it. It also makes it very tricky when you start getting into these types of situations also to put on convoluted spreads because you don't know when that pullback might occur, how severe it might be, and what the market's going to be doing when that happens. So the trade that I've come up with is a very simple one. I'm looking at the June 43 puts. I'll give you about $1.50 for those things. The idea here is that I want a trade that's going to be nimble. I'm going to give myself a little bit of time, but basically if this does have a fairly sharp pullback, I'm going to have an easy way to monetize it. I can do a couple different things. Either I can just sell it, or I can try to work my way into a spread. Either way, but I don't want to get into a really convoluted spread up front because I want to have that nimbleness later.
Well, Michael, simple. You said it yourself. I mean, listen, the buy
situation isn't simple, so you need a simple.
No doubt about it. Hey, listen, like I said, the other day when the stock was at 47, I actually bought a weekly tight put spread, okay? And all of a sudden, I mean, I'm kind of a genius every once in a while.
What was tight?
It was $1. I bought the 46. 45, the thing dropped to 44. I doubled my money very quickly. Now, here's the thing. I didn't take it off. It went right back to 47. And then the next day, you remember this? So the thing's moving around 3-4%. I don't want to be short a stock like that. So if you're either long a put, Okay, the vols are going to be moving around, you're going to be making money there. But I think you want to do a vertical spread, and I think you want it closer to the money. You know, that's kind of my take. You've got to be really right to make money on that.
One of the things about a vertical spread here, and that I think doing the weekly makes a lot of sense, is that when you're doing these vertical spreads, they actually will get monetized when it moves if it's a really short duration like that. But if you're going to trade a longer dated type of structure like this, the spreads aren't going to work as effectively.
All right, at this point, we've got to hit the stocks versus options button because this is a good illustration. Want to short silver? Well, that's just about as risky as jumping out of a plane. You can get your head taken off, as Mike says. But Mike's put purchase offers huge leverage and defines his risk to $150. Not bad there. Got a question? Send us an email. The address, you know it, optionsaction@cnbc.com. And for the record, I do read or try to read all the emails. Here's what's coming up next.
Last month, Dan did the unthinkable and